Louisville, Kentucky was 4 of our first purchases. We focused on that market because the market had job growth, right? So moderate job growth, 2 to 3%, moderate population growth, had job diversity. There was no one employer that made up 20% more of the market. The MSA, or the Metropolitan Statistical Area for which the properties are, has at least 250,000 people. So we weren't going to have a limited supply of people. We weren't a college town or a military town. We were a landlord friendly town. We did not have a rampant supply of new construction that could bring down the value or the opportunities of our properties. And then we would look at which submarkets could speak well to workforce housing, to blue collar housing, right? So Louisville was one of our first markets. We've transitioned in others. Predominantly now we're mainly in Nashville, Tennessee, and Atlanta, Georgia. Same kind of metrics, right? We're looking for those neighborhoods that fit that pocket. We look for anywhere between 75 to 150 units, because that serves to be able to accomplish that part of scale where we can hire that team. You can hire full-time people for less, for 50 units, 25 to 20 units, but it becomes not effective because it's too much of a cost for the property to have as a burden right there. So we look for that part, 75 to 150 units, in BC markets, valued somewhere between 7 and 15 million. That we can find that will have a good operational upside, whether they're underperforming on the property side, where people aren't taking good care of them, or the management side. The plan that the current management has maybe is not the most effective plan for the property, right? So we look to target those, and we find these through a lot of broker relationships. Probably 70% come from broker relationships. And then the other 30% comes from just being in the market through relationships with property managers, word of mouth, or just direct to seller, right? And so we've been able to do this as we've grown, and that gives us more reputational prowess. Now, one of the most attractive things for larger multifamily is the debt options. When you can find properties that are good properties, there's a lot of lenders who want to be able to lend on these properties. Multifamily, honestly, is one of the safest asset classes when you look at the potential to be able to cover the mortgage, right? Instead of having one tenant who's you're either 0% or 100% occupied. We have 100 tenants. So we have 5 move out, we're still at 95%, and there's still a very good opportunity for us to pay all of our expenses and our mortgage throughout the property, right? So it's a much safer environment. I think, honestly, the forfeiture rate back to 2007 was something like less than 1% of all multifamily properties had trouble at that time, just for the simple reason, right? Is that, and even today, when we see these high housing prices here, multifamily becomes even more attractive because with inflation, with raising interest rates, people are having a hard time affording a house, and there's just not enough supply, so they're going to be able to push into rentals for longer. And as we look forward over this decade, we need about 15 million housing units to be built, almost closer to 16, and we're going to build about 10, right? And so what that means here is we don't have enough supply. Right. So people that are trying to buy houses just 6 months ago can afford, subjectively, probably, 30 to 50% less than they could, or 30% less than they could a couple months ago. So they're going to rent longer. And so that's going to continue to accelerate the pressure on apartment buildings, and also continue to increase the rents. Now, it serves to get back that you want to be in good markets, right? Because they're going to have the most value. But that leads to say that multifamily continues to be a very good asset, continues to be one of the strongest assets today and going forward. Yeah.
And you mentioned debt financing. Are you experiencing any changes with lenders? Obviously the market's changed a lot. The market factors have changed a lot since the beginning of the year. Are there differences now in programs? Are there lenders that are no longer offering options, or what are you seeing?
All of the above. Very similar to when COVID happened. There was a lot of lenders who just stood on the sideline for a minute. Let me just see what's going to work out, or start to add different provisions right here. So that's all of the above is happening. We work to use either agency, Fannie or Freddie loans, or local banks, community banks, regional bank loans, or there's bridge loans, which are basically like construction loans, or you could even call them hard money loans. We want that apart. A lot of the bridge lenders today are really have pulled out because they don't want to commit to a loan and then find themselves where they have to retrain that loan for a number of months. So we've continued to look for options. That our approach has always been find loans that give us the best potential to be able to make the right decision into the future, right? And so when you think of a loan, you want the loan to be an accelerator for the asset. You want it to be able to help the project, right? And so we don't want to get into a loan where in a year, I may have to make a decision based on the loan when it's not in my favor in the market, right? Because you can think of, a year back, if I was to take on a loan thinking today was going to be just, all rosy and perfect world, I would be in a huge disadvantage because I'd have to be able to take this loan out. So we look for loans that we just closed out a property here in Nashville. It's like $14 million asset that we have a bank loan for a regional bank. It's a 5-year term. Typically for commercial loans, you get a term, right? So it may amortize over 20, 25, or 30 years. However, we'll get a term for where the loan will have a balloon on it. So we'll have to re-up. So we have a 5-year term for which we have 2 years of interest-only payments. It's amortized over 25 years. The rate's 5.35. And for that, we don't have a prepayment penalty. So within a year or year 3, or at the end, I could refinance, sell. I could do a number of things, and I wouldn't have my back against the wall within, 18 months or 24 months where this loan is coming due and I have to make a change, right? So we constantly want to look for loans that put us in a good position to control the narrative in the future. So when the chance comes up to capitalize on the market continue, turns around, turns in our favor, interest rates come down, I can create different value sets by changing up the loan structure on the property because I have the advantage of doing so.
Got it. Okay. And is that loan that you just mentioned, is that a Fannie or Freddie, or is that a local bank?
Local regional bank, so Simmons Bank, right?
Oh, okay.
So they're out in the Southeast here, and they gave us a loan on that property right there. It's a loan to cost. So it's basically a part leverage, and then they carry the construction part of the project too. So they give us, I think, subjective like 68% on the purchase price, and then 100% on the construction.
Wow.
So in range, it comes out to 71% of leverage across the property for the total sources for the purchase price plus the construction.
Yeah. So if you're listening to this, a lot of people, I think it feels like this money that people are getting for these types of properties is like unicorn money. Like I have no idea where to find, debt like that. Like who's going to give me a loan like that? Well, it's just local relationships. Like this is just a local bank and they're all going to have different sets of terms. But like you said, it's a very, safe comparative to other investments, a place for them to put their money as a bank and get a return on their money. These are out there. They're in every single town. There's local banks. So you could just walk into a local bank and tell them what you're looking to do and the type of project you're looking to finance. So don't feel like this is, only Jason is able to get this type of financing because he's got this special handshake or something. It's like, these exist and they're real. So it's funny. You started back 2017. I remember around that same time, I was looking to transition out of single family houses or looking to just like maybe expand beyond single family house rentals as well. So I was exploring multifamily as an option. I ultimately landed on vacation rentals. That was the route I decided to focus. And I think, you should have a focus if you're listening to this and you're trying to just dabble in a little bit of everything. That's a tough road to go down. I ended up going down the vacation rental road, but I remember listening to podcasts back then in 2017 and hearing the exact same thing that I hear sometimes now, that it's too late to invest in multifamily. The market cycle is over. Obviously, you've done pretty well for yourself since 2017. People are still saying this. What's your take on that? Like, how do you judge the market cycle and decide that you still want to continue to invest?
Sure. So good questions. And I know people, the same thing in 2016 were saying, I'm sitting on the sidelines, you're still sitting on the sidelines, right? And so at some point to act, you can continue to be a player in any market. And you have to realize that the talk track, the narrative for recession or market cycle, it's not the US. It's your area that you have to pay attention to. right? And so looking at the areas that have the drivers, right, where people are moving to, they want to be on, there's a lot of growth, a lot of progress, a lot of jobs happening here. That are the areas that you want to focus on because they're going to continue to be of need, continue to be of want during any time, right? And so I would not want to be in more tertiary, secondary, like really markets that you have to, take a plane and take a bus and take a train to get to, right? I want to be in markets that can be served by a number of different people that can have a lot of job drivers coming to them. What is going to continue to carry properties here is that when you look at inflation, you look at interest rates, let's just talk inflation. Well, it's hard to build these buildings right now, right? We can't keep up already. We haven't met demand for supply of units since 2007, 2008, right? Here we are today. Maybe we might hit it in 2026 just for that 1 year, but still be about 5 million units short. And when you think about building today, it's now costing more, supply chain issues, labor costs more, right? So these projects are harder to get aligned and harder to get accomplished. So it creates that they're going to cost more once they're complete. And because we have buildings that are already in place, it's going to continue to drive up the value of our buildings because our buildings, to replace them, would now cost X to get there, right? So it creates value in our buildings there. And as you look at these certain markets, you look at rental rates, because of the downward pressure, there's not enough rentals. I mean, we're at a historic low for where vacancy is in so many markets right now. New York City, a year ago, everybody said is dead, has less than 1% vacancy right now, 29% rent growth in the last year. Right. And so you look at these markets here, there is no supply. And you have all this pressure where the rental is continuing to grow. Now, we do have to track that wage inflation versus price inflation to make sure that the jobs can support that, right? Because you can't just keep, increasing people's rent forever. But there's that motion here. We're going to continue to have that demand in multifamily going forward. And although we may slow in a way here, it's not going. We're not going to see this massive dip because of all the supply constraints and all those other issues that we just targeted right there. What you will see is that the slowness will come down to retraction in some of the loans or some of the loan values put out to potential that you will have two choices. Either people will be willing to buy these buildings and take a little bit less in returns, right? Or prices will lower. And we'll probably see some mix in the through line. Now we're going to see some massive drop, probably not, but we will see some regression right out there because banks have been, they're not lending at the same leverage as they were lending before, right? They're lending at lower loan value. And so typically when you look at a project, debt to get yourself a loan is going to be cheaper to buy it in all cash because you want a higher return on your equity, right? So when you look at yourself, that's why most of the time you're not buying a bunch of things in cash because you can put leverage on it, the power of real estate to create better returns with your equity. So the more leverage or the lower leverage you get, the lower your returns will be. That if you're able to get a 70% loan compared to a 60% loan, probably your returns will be able to be much higher on the 70% loan with the equity side of it compared to the 60% if the interest rate and falls in the same line.